All right. I guess a lot of people are stuck in traffic. Let me just get started. My name is Surasit, and I'm the Chief of Operations of Sasin Entrepreneurship Center. I probably have to introduce myself today because my partner is a bit running late. So basically, we do, as part of the Sundowner talk, it is a monthly event that we host a talk mainly focusing on since we are from the academic background, we want to help educate and help guide entrepreneurs and to help improve the startup ecosystem by using people who are experienced in different topics to come and share their experience. And yeah, so it's just a monthly, and also it's a chance to network among entrepreneurs, investors, etc. So today we had around 30 plus signups, but because of the traffic and rain, some of them might be showing up a bit late, but usually we have around 30 to 50 people showing up at our talks. So a little bit about me. I just graduated from Sasin last year, and I'm working on a startup called Hungry Hub, which is an online restaurant reservation system in Bangkok. So I've been running it for a year, but prior to that, while I was at Sasin, I competed at multiple business plan competitions. I was focusing more on the finance side. Hence, I've been doing a lot around valuations, talking to investors, coming up with different valuation methods, and from the very basic side up to the very complex side. So I hope I'll be able to share some simple techniques. And a lot of people come up to me and ask that, hey, can you just share me your Excel file or something like that. And today I'm just sharing the simple one that I use, that I kind of customize from many different ones. So if you have a computer and you want to follow me today will be mainly a kind of like a workshop running through the Excel financial model on how to derive your company's valuation, but also talk about a little bit about why you need to do the valuation and what are the different ways to come up with the valuation. All right? So there's going to be some technical terms along the way, and you guys can just stop me anytime and just say, hey, can you please explain this in more details, all right? Okay, so I think this is something that a lot of startups with no finance or no business background would kind of have a question, because VCs always ask you this question. So what's the value? What's your company's value? You're looking for $1 million. What are you willing to give in exchange? How do you come up with that number? Is it just a number in the air, or what are the ways to come up, and why do you need it? All right. So a lot of people say you need valuation for the purpose. You need the company's valuation just to get external funding. I say it's not really true. I mean, valuation comes down to everything. Is this company worth investing your own time in? Before even talking about getting external investors, is this company, based on the revenue projection, the cost it will incur, the operating cost, the setup cost, all these kind of things that involve, is this a scalable business? All these kind of things comes down to the valuation as well. So is this a lifestyle business, or is this a scalable startup? You can see all based on the valuation. So what is the simple checklist that you will need before you go to figure out your valuation? Without these things, you will not be able to figure out your valuation. All right? So these are the simple things, at least, that you will need. First thing is the business model. And what I mean by business model is how you're going to make money. Right? So in order to do your revenue projection, you will need how you're going to make your money and how much are you expecting to make. Right? And that is business model, which is, are you going to make a commission basis on something? Are you going to make an advertisement fee on your app or something? Are you going to charge a listing fee for your customer to be on the app? Are you going to, so example of a commission would be, let's say Uber, Grab Taxi, taking commission from each ride that the customer takes. And it can be a percentage commission, or it can be a fixed dollar value commission, right? Ads would be, for example, games, online games, all these apps that come out with games, they do advertisement within the app, and that's where they make money. So in order to figure out ads, you'll have to know what, so it's based on how much users you have, how much active users you have per day, how many page views you have. And based on that, you can calculate back to what's the cost per impression that you'll be able to make. So these all derive to, and of course, you have to multiply by sales projection. So sales projection in a technology term might mean, let's say, how many bookings of cab, how many restaurant bookings, for example, in Hungry Hub case, or how many users, or how many page views if you're selling ads. So these are all the things that you need to project over a period of time, at least for 3 years. In the past, VCs used to look at 5 years projection, and you can still do that, but for early stage, a lot of people are still looking at, now starting to look at 3 years number. And of course, you need to know what's the market size of your business. This is not, I would say it's not entirely necessary if you're going into a market that is entirely new and there's no way to estimate. But you should be able to know that let's say if you take 100% of this market share, how much is that amount? If that amount is $10 million, then it's too small for investment. If it's 100 million, close to $1 billion, it's more interesting. Because as a VC, I will never believe that any one person can take 100% market share. And if your sales on year 5 or at the end when you're exiting is less than $10 million, the chance of you selling your company for 100 million is almost impossible. Because, and if that is the case, then VCs are not going to get that huge return and they're not going to invest. So they usually look forward at how much they're going to be able to sell your company on the point of exit. And if you backtrack based on the risk and the cost of capital that they have, does it make sense for them? And I'll show you in Excel terms how that makes sense, whether something is worth investing or not worth investing. All right. Second, the third thing is the setup cost. This is just, for example, let's put an example of, okay, you're going to start a restaurant, right? Let's say it's a business. You're going to start a restaurant. So the cost of the design, all the first time deposit, all these costs are like one-time setup costs. You're going to set up a factory. These are the first time, right, in order to get it. And then, of course, the operating costs. So this is how much you're going to burn on a monthly basis. What's the salary, how many employees you're going to have, what's your rent, what's the cost of goods sold if you're selling a product. And lastly, and most important, is what is your estimate marketing cost. In a startup world, this is probably one of the biggest. I mean, it depends. If you're doing a B2B based startup, then probably less. But if you're doing a B2C based startup, then this is probably one of the biggest number. And you need to know how to come up. The biggest question VCs ask is, what is your cost of acquisition? Which is kind of towards the part of marketing costs and mix of operating costs, depending on what product you're doing. So cost of acquisition is almost like cost of goods sold in a manufacturing industry. All right? Everyone understands cost. Does anyone not understand cost of acquisition? So it's basically a cost that you have to pay to acquire one user on your platform. So that's kind of like in the tech terms that's usually how cost of acquiring one customer to buy your product. Okay, what are the different ways to value your company? The first, I think this is the simplest way, using comparables. So market and transaction-based comparables. Now what I mean by this is, let's say you've to look at how WhatsApp was valued. I'll show that in a case study. You can simply just put a valuation based on, so WhatsApp is a private company, right? Before it got sold to Facebook. How do you compare that? What industry is it? It's in the social network industry. So what do? You take a few social network companies that are listed in the stock exchange. WhatsApp has almost no revenue, so you can't do a revenue projection. So what you need to use is a user-based comparison. So you take a company's value of Facebook, for example, and then you divide by their number of active users or their user base. And then based on that, you multiply by WhatsApp users, and then you kind of come up with their valuation. So that's like an easy way to come up with valuation. When you talk to investors, you say, hey, for example, my competitors just recently raised a round for $2 million value, and they have 20,000 users. So let's say their user base, it's $1,000 a user, or whatever the amount, and then you multiply by your user, and you say, hence, I think my value should be around this much. But this is more like a supporting statement. You cannot say that you entirely value your company on these terms. It can be more like a discussion or more like proving that my valuation is all right. You cannot say, here's how I did my valuation for a VC. But as a VC sitting, listening to your pitch, this is how he's going to value you very quickly, whether it makes sense or not. You value yourself at $2 million. Your competitor just recently raised around at $5 million. Their users is 20 times of yours. Doesn't make sense. But again, depends on the industry you're talking about. If it's a user base, doesn't play an important role, but there's other business model that plays a better role, then obviously you got to look at that. Revenue comparables is another way. So let's say a company just raised a round. You don't know their user base. You know what's their revenue. So you take the value of the company divided by the revenue, and then you take your revenue, annualize it, and multiply it by. Take your last month, your best month's revenue, your latest month. Don't take whatever you have done till date, because you're going to keep growing. So let's say you take your latest month, or maybe your next month revenue, multiply by 12, and then multiply by that ratio. So let's say, given an example, a company has $1,000 revenue, and they are valued at $1 million. They just raised, right? So that's like 1,000 times revenue. So if you have $500 revenue, you can say, my valuation is around 500,000. So that's like a quick way to check whether are you intact, are you along the same line. Obviously, you got to see other factors within why that company got $1 million valuation. Is it because that team is like ex-CEO of Line that is starting a company? There are other like huge factors that made them got like that exploded their valuation or not. But if everything remains constant, you can just say that revenue to value is also one method of comparing. All right? So these are more like the quick and dirty way of saying, if you're sitting in the audience and someone is throwing up a number in the air, and you can quickly compare to their user or to their competitor, you will know whether their value is a good deal or not a good deal very quickly. All right? The second is, this is non-tech focused valuation. This is more like talking about real estate and stuff like that. So it's asset-based value. Let's say, for example, you're real estate heavy, or you're something that has tangible value. And if your company is entirely based on that, let's say a Sansiri, you have 20 different properties. You can estimate that what's their property value. Just take their square meter and multiply by how many square meters they have of each property, and quickly come up with a valuation. So that's one way of doing it. And that's quite a simple way for a more tangible asset heavy type of business. All right. The last one is what applies to pretty much all industries. It's called discounted cash flow. So how this works is basically you've got to project your future revenue do a full financial model, and then discount it to the present rate and put in some discount rates that is higher than industry standard. And then you'll see what's your net present value. And based on that, that is your company's valuation. All right, so today I'll be focusing on this discounted cash flow because at the end of the day, most VCs will ask for your cash flow when they do due diligence. Yes? Not industry standard. I mean higher than, so as a startup or as an early stage, your discount rate is higher because your risk of failure is higher. Yeah, so usually they say that as a startup, if you just started, 50% discount rate. That's the industry standard. I mean, if you're doing a very risky business, probably 70, 80%. It's just idea stage. But once you have customers, then it slowly goes down. Yeah. If you look at listed companies, most of their discount rate are between 10 to 15%, 20%. So those are like public company. So you being private and being a very early stage, the chance of failure is much higher. How people come up with discount rate is taking the probability of success over probability of failure. So let's say 30% probability of success, 70% probability of failure. 30 over 70 is around 40%, kind of something like that. Okay. Let's look at what I mentioned earlier, WhatsApp acquisition. So as I mentioned, Facebook acquired WhatsApp for 19 billion. I think at the time that they closed, it was close to 22 billion. But at that time, WhatsApp had a revenue of $20 million a year. Now that's like, if you take 20 billion over 20 million, that's like 1,000 times, right? And no industry has like 1,000 times. This is not even PE. This is like price over revenue. Most of you have heard of the word PE, right? Price over earnings. And that's earnings are EBITDA, which is after your expenses. But this is like price over revenue of 1,000 times, right? But a lot of people were like, Facebook's like probably dumb or like stupid for doing buying WhatsApp. But if you look closely at their user base, they had like 450 million active users at that point. And Facebook had, I think, around 100 to 200 million users at that point, active users. Means on a daily basis they were coming to the same application and spending hours. So at that point, Facebook was trading on the stock exchange at, if you take that company's value over the number of users or active users they have, it was coming to around $145 per user. Twitter was around $128 per user. WhatsApp, if they take this over this, it's coming to $42 a user. So if you just look at the user number, and obviously the vision and the team and everything else plays in as well. But just looking at why they bought WhatsApp was because the app had connections with users all the time. It had data, it had everything else. But most importantly is it has that big user base. I mean, again, this is just an assumption looking from outside, why the value made sense. All right? Any questions about this one? Okay, now this is just a quick run of terms. What are the common valuation terms that a lot of VCs ask startups or tech startups especially? The first one is the pre-money and the post-money valuation. So what is pre-money versus post-money? Pre is basically, so when you do a valuation exercise using discounted cash flow, you basically have to assume that you get that investment. You have to put in the money into the company, that there is some investment into the company, all right? So that the net cash flow doesn't go to zero, because you need money to get started, right? Usually you run at a loss for a certain amount of time, and you need money to be able to support that loss. So pre-money is, let's say your valuation is 2 million after doing this exercise. After doing this financial exercise, your NPV is 2 million. NPV is post-money valuation. So if you've taken investment of 500,000, your pre-money valuation is $1.5 million. So you simply just minus the investment amount. Take NPV, net present value, and I'll show you on the Excel how it works, but just minus the investment. The post-money is just the NPV. All right, so don't get confused. A lot of people get very confused by this term, pre-money, post-money. So your whole value, some VCs talk in pre-money only. They don't talk about post-money. So you have to be very clear when you come up with your valuation, whether it's pre or post. All right? This might cost you a lot of money if you didn't understand it. Because if you say that your actual post-money was $2 million, and you went to say that your pre was $2 million, then obviously you're getting more. But if you say that initially your pre was $2 million, but you went to say your post was $2 million, then you're getting less, right? Break-even point. This is how many months it takes for your company to reach cash flow positive. Now that means every month you're running on a loss for a certain time. You're spending more than you're earning. But there'll be a point when your company hits break even and you start to generate some money. So that is break even. Some people call it the payback period, but in a lot of terms, payback period is, let's say you take $500,000 from an investor. So at which point do you make $500,000 in your company? So that will give you, that is your payback period. And last one, this is a very new term that a lot of VCs are talking about. What's your burn rate, right? What's your average monthly burn rate? And that's basically how much you're spending. What's your monthly operating cost? Simply that, taken like that. All right. So what are the factors that sometimes affect valuation? These are some things that cannot be valued, and it's just more like the acquirer sees that benefit in that startup or in that company, and that's why. So first is, I will put it under the category of goodwill. Goodwill is more like patents, IPs, trade secrets. So those are not part of the company's value because it's not under revenue. It might be under R&D. So it's work in process. It's like an asset for a company. Like, for example, Google bought over Motorola for $12 billion in 2011, and they sold it for $3 billion in 2014. You wouldn't think that Google is dumb, losing like $9 billion on a company. But actually what's in there was 20,000 patents that Motorola had that Google, once they acquired, they separated into their parent company and sold the rest of the company clean to Lenovo in 2014. So this is just an example of, you cannot just take the valuation of Motorola and divide it by revenue and say, oh, it doesn't make sense, because there are other factors within there that was causing the valuation to spike. Right? Brand value, very less in terms of startup, not that much yet, but in big companies, marketing companies, there are a lot of money in brand value. Team, acqui-hire, this is more like a Silicon Valley term. You buy a company because you just want the team. It's a very strong engineering team, very strong tech team. You just pull out, you don't care about the product. You want the team to join your big company, hence you overpay. The company is not making any money. How come they sold for so much? So that's also another reason why you should discount that out. Synergies. For example, Expedia are buying a lot of companies. If you're in the hotel online booking industry, you'll understand that Expedia is charging, let's say Expedia is charging 25% commission flat for any booking to any hotels from Expedia's website and the affiliates, right? So recently they just bought over What If, which is the Australian online hotel booking website. And What If was like their close competitor in the Australia and other markets. So instead of going to compete and try to get that market share, they say, if I buy what if, and I can just change the amount to 25% from 10%, and hence the value for me overall will be much more. Maybe right now what if is not making that much money, but if I go in and increase, and since my policy is 25% across the board, I'll become monopoly. I'll get more once I get them on board. So there are many other factors which you don't see as a company on their own, but once they get bought over, you'll see much more value over there. So synergy value, replacement cost is too high. For example, Priceline taking over OpenTable is more of a synergy. They have been in the flight booking, hotel booking. They want to get around all the verticals of online booking, hence they just got over OpenTable, and it makes perfect sense for them as a vertical integration. User-based value, and I explained about WhatsApp. Snapchat recently raised around $20 billion value as well. So these are all. Now I'm just going to go through the financial model. So more like how using Excel formulas, how to come up with your company's valuation. If you guys want to follow and you have a computer in front of you, you can try to put in this link. I'm not sure if it works, but it was working earlier. So you can just download the Excel file and just follow through. Or otherwise, you can download it later. If it doesn't work, you can shoot me an email, and I'll send you the file. All right, so this will be, I'll have to sit down because the mouse is here. How to reduce that? Okay. All right. So just I'm gonna explain the different sheets of this Excel file. You guys can follow, and if you have any questions, just stop me anytime, right? So this is more like the quick financial model that I think every startup should have before they even start their company. Maybe not 5 years, but at least 2 to 3 years to see whether it even makes sense to start this startup, all right? So this is not difficult, and I'll explain to you. This is based upon more like around Hungry Hub terms with the numbers maybe not accurate. This is more when I started it up. But I'll explain to you what each one means and why I came up with this. So for Hungry Hub, there are 3 ways that when I started, after doing a bit of research, I said that, okay, these are my 3 financial models that I plan to do. One is I can charge a restaurant when they join the platform. Okay, so just a bit of background. Hungry Hub is an online restaurant reservation. So similar to Agoda for hotels, this is booking for restaurants. So like a table booking system, right? So there are 3 ways that I can make money. One is through signing up. Whenever they sign up, they pay a fee. Second is a monthly subscription that they can pay me monthly for maintaining the system and everything. And third is on a booking basis, they can pay me as a commission. So there are 3 revenue models which add up to my total revenue here. So if you guys follow, it's always, a lot of people talk about this, the market size is $100 million. If I capture 5% of this market share, that will give me $5 million and I'll be happy. This doesn't work for VCs, all right? I think a lot of VCs in the past might have been looking at like that as well, but now VCs ask for the bottoms-up approach. That's called the top-down approach. But obviously, you need to look at the top-down approach also. And the reason is that, let's say your bottoms-up approach come up to a revenue of $50 million, and the market size in this industry is $80 million. And as a VC, our question, will you be able to get 60% market share? It doesn't make sense. There's, in the history, or in other countries, does companies get up to 60% market share? If not, then again, you have to adjust and make sure your number is reasonable. These numbers are just up in the air. But you gotta be able to, it has to be reasonable. It has to be validated somehow. The more you give, the more you prove to the investor that these are reasonable numbers you're able to achieve based on research or based on talking to restaurants or based on talking to customers or people in the industry, then obviously you get more credible from the investors. Because it is easy to make a fancy number, but it's hard to live by it. And when you set high expectations, VCs are going to grind. You might get money, but you won't last long. If you set the expectation really high and you can't achieve it, then they're going to withdraw. They're going to like not support you all along. All right? So I'll just run through how I came up with the numbers. So the first 2 years, it is best to do it monthly. So I would put it on a monthly basis for the first year, because the growth will look better. Because let's say, so first month I put in, okay, I'll sign up 10 restaurants, so 10 new restaurants, right? Second month, 10 more restaurants, so adding to 20, and so on. So for, let's say if you're doing an e-commerce, how much of your product are you selling? What's the average product price that you're putting on it? If you have 10 different products, then you put 10 different pricing and how much you expect to sell of each product. So you can just make as many revenue streams. This yellow, this one you can just make up. It's very simple, right? So you can just keep on adding and just make a sum. So this is like a sum of this two, this is a sum of this is a sum, and then the total revenue is the sum of all the revenue, and then convert it to US dollars. It's very important to make it consistent and try to keep in US dollars as much as you can. All right? So a lot of investors, even though they're in Thailand, they get their monies usually from overseas, and they usually talk in US dollars terms. All right? Okay, so any questions on this side, on the revenue sales projection? You need to come up with how much you're going to make on a monthly, how many units you're going to sell, what's the price that you're going to set. You can increase the price later on, and then you can see, like, for example, for the first 1 year, I didn't charge any fee. That's like my marketing gimmick, right? So the second year, I still didn't charge any sign-up fee. And I started charging monthly subscription fee. And I started charging commission from second year onwards. And then it started showing revenue here. So again, this is just a sales projection. And then how many restaurants I'm going to have. These are all like monthly basis. Then once you get to year 3, year 4, year 5, you don't have to make it monthly. If you want, you can still make it a quarterly basis, but it's not necessary. All right, so that's the revenue. Now from the expense side, as I mentioned earlier, these are mainly operating expense. So marketing, cost of acquisition. So this is like a sign-up commission, right? So cost of acquiring each restaurant. Salary expense. Online marketing, offline marketing, rent. These are the basic ones which almost all kind of company or tech company will have to put in. And again, the first 2 years will be best to put in on a monthly basis. And then you can just add up. I mean, the numbers, because it's just projection number, it will look very fancy, like $500 a month. But obviously, in reality, you got to adjust every month after you put in. Okay, so this is the first quick and dirty financial model. And this is not only for valuation purpose. Again, you can just use this one sheet as a guide to yourself to show whether, hey, does it make sense? What's my target in the first year? What's my target in the second year? If you just have it in your head, you might not be able to change that easily because there might be many revenue streams, many different expense that it's better off putting it on an Excel. Okay, now coming to the more, I would say, more complex file, but don't get scared by this file, this sheet. So this is kind of the sheet I got while in class at Sassin. This is like a detailed sheet of everything you need to put in terms of financials. All right. So the first bit of the sheet, it says here commission fee, reservations, number of reservations, and your total sales. So what you can do is you can just link this up from here, from your total revenue. So you just take your total revenue and link it to total revenue of each month. So this is equals to this, and so on. All right. I've already linked it in somehow, so you can just backtrack. If you have any questions on any of the field, linkage, formula, you can just email me. But I'll just run through the basic stuff. I've highlighted which field you have to make sure it's correct, and it is the important fields, I would say, of this sheet. The rest, you just have to leave it because they're all formula linked along. So the important stuff are your revenue stream, your cost of goods sold. In tech companies, in tech startups, usually your cost of goods sold is 0 unless you're e-commerce. Then you know what's your gross margin, you can work backwards, your cost of goods sold, okay? Because you don't have additional costs on each transaction. Okay, now initial setup cost, like I mentioned earlier, what's your cost to set up the factory or your website or your IT, your rent, everything deposit. So it's more like a one-time fee that you have to pay to set it up, to get it off the ground. Moving on, these interest, income, depreciation, all these are all formulas. So if you notice, only the blue fields, the blue text, are the one that you should change. The one in black are all formula. So you don't have to adjust anything in black at all. And I've highlighted the yellow fields that are more important ones to change. Some of them are like basic, like tax on income. I put it as 30% standard. If you are on BOI, you change it to 0 if you get tax levi. But again, that's not the most important thing on this file. So pretty much standard here. The reason why it's made in such a way is that it will link into a full financial statement. So after adjusting this, you'll get your 5-year cash flow, 5 years balance sheet, 5 years income statement. And that's what you need to give to an investor at the end. So they will ask you for your balance sheet, as part of your business plan. Most of them will say, can I have your cash flow? That's the most important thing. So as you know, for startup, cash is king, right? So you cannot show at that point that how much is your burn rate on a monthly basis. You can't go to cash flow negative. So I'm just moving down. Okay, here comes the important thing. Equity funding. So how much investment you need. Now this number, again, as of now, you probably won't know yet. But at the end, I'll show you how this number has come about. Right now, I'll put it for, the whole Excel is based on thousands, right? So 1,000 is $1 million investment. I put it as $1 million external investment, all right? But how did I come up with $1 million? Let me show you in a bit. Okay, these are net cash flow, opening cash balance, ending cash balance. So again, these are all formula driven, so you don't have to change anything. This is your asset purchase. So if you have any assets, then you would have to make sure it is all input in there because there's depreciation cost over a period of time, and that's expense. Okay, here comes the important part. These are I put it as tech and R&D expenditure. So how many tech employees you need to have, what's their salary, Over here, you're talking about their salary. You don't have to put in all these fields. These are all formula. So you just have to put in their first year salary, their second year salary, and so on. So you have to adjust their salary throughout all 5 years. And later on, you'll put how many people you need for each role. So these are all in US dollars again, and in thousands. The one means $1,000, two means $2,000. So again, a CTO shouldn't be making so much money if he's part of the team, as in he's part of the founding team. But if you're hiring a CTO, then you probably, and he has no equity in the company, then probably have to pay more. These are put in a number as of Thai company. So if you have any questions, you can just refer to why this number, does it make sense already? Yes?
Yeah, you touched on something that I'd be curious about. From an investor's perspective, what is a reasonable salary to pay somebody who's one of the founders of the company?
Again, depends on your experience, your costs.
Well,
Okay.
Let's say that you know what the person would normally get going out and working for a third-party company.
Yeah.
What fraction of that, or what relationship?
I would say that more just to be able to sustain his life. I wouldn't say that you cannot compare to how much he or she can make outside. That number is like out of the question.
Right.
Yeah. So some VCs would be happy if you're not paying yourself, but some VCs wouldn't be happy if you're not paying yourselves, because that means it's not sustainable yet, right? But if you put yourself with the same salary as you're working outside, again, that's not a good sign. That would be good once you have reached like a third round financing or second round financing, where if your equity in the company has been diluted to a fair bit already, and now you are like a hired CEO with equity. But obviously, Mark Zuckerberg's salary is still $1 as a director in Facebook, right? So again, his main value is based on his shares value, and he can sell that anytime because it's publicly traded. But you need, it's always good to put, and then you can increase it over time to be more than your employees. But at the start, I would say that, let's say in Thailand, a founder should make maybe, my guess, this is just my opinion, right? 20 to 50,000 baht, not more. Yeah, I mean, just to sustain your life. If you say that you're making 150,000 baht a month, I mean, depends. Your costs, different people have different costs to incur, right? If you have to pay rent that's really high, if you have 2 kids to feed, all that kind of thing, then obviously your cost is more, and you have to reply to that. But if you are a tech founder who's like young and still has low cost on a monthly basis, then obviously you shouldn't put it too high. Yep. If an investor see you driving a Mercedes to the discussion, then it's a big question mark, right? All right. Now moving, so all these kind of employees, the next is what's the materials that you will need. So this R&D can be changed to tech materials. So if you need iPhones, 10 iPhones to test, or you need whatever 3D scanner to test your product, or all these kind of things, you got to put it all in there. So these are materials that you need. IP rights. Now, if you're paying license for anything, then you got to pay. You got to put it in there. Now, this is how many. This is a human resource worksheet. So how many employees of each position? In the past, you put in the salary. Now you put in the amount of people that you will put in under this salary. Again, now this comes to marketing. So how many CMOs are you going to have? How many CSOs? You can change these positions and the value as per you want. But this is under sales and marketing, and it will link to the sales and marketing section within the financial statement. So don't link up your HR head under sales and marketing, because the overall cost, the formula will be linked wrongly. And again, this is the CEO, CFO, COO, admin, support staff.
Can you explain again what's the 50 and the 20?
50?
What do they mean?
So this is more like so in marketing and so in terms of sales volume to staff ratio, if you have let's say you're selling 50,000 products and you need one employee per 50,000 products. So you can put it in that terms, or you can just ignore this one and just change the number from here directly and how many employees you need. All right? So sometimes you pay like more like a commission basis per volume. This is more like a manufacturing, more like a product basis. All right? So let's say logistics. You're paying them 60 baht per transaction. So that's if one person would be a salary of 20,000 baht. So you just take 20,000 divided by 60, that's your ratio. So if you sell X amount, then it will just turn into one person. This is the salary of your different positions. Commissions, if you have any commissions per sales, you put in here. Benefits are, these are more like Provident Fund and all these kind of things, which usually in general is put 15% as average. If you have more benefits in your companies, then you can put in higher. But this includes the basic benefits that covers. Marketing material, this is important. So all the costs involved in marketing. I would highlight this. I'll update this file later on. Again, this admin staff, if you don't have the ratio, just put in the actual number in here. Lease expense, so this is more like your rent, your equipment costs, and your IT supplies. So once you fill up all these details, I'm coming back to the equity funding that I mentioned earlier. Now you will see that your ending cash balance, as a company, you have to make sure your ending cash balance never goes to zero. All right? So if you see this, the lowest, it went down to 15. So I'm going to change it to 0. Let's say if I don't take any external funding. My ending cash balance will keep on going down, right? So it will keep on going down because I'm making a loss every month. So I'm losing money every month. I need some money, but I don't know how much. How much external money do I need? So my question first comes up, how long do you want to raise this money for? Some startup says, I've raised like 5 times before, I've done 10 startups, I can raise again in 6 months. Hence, you would raise a smaller round. Why raise a smaller round? Because you would get higher valuation in the next 6 months. So you lose lesser of your company today. All right? Now this is very tricky. But I'll say in Thailand, there's not many of people who have raised multiple times. So I would suggest most startups raise for at least 1 year to 15, 16 months at least, because at the time it takes to raise a round is usually 3 to 6 months. That's average. Sometimes it takes up to a year. Sometimes you can close it within 2 months. It's about how good, how connected, how well performing is your company. But anytime, the due diligence process takes at least 1 to 2 months for the first round, sometimes up to 3 months. All right? So if your company is running low on cash at any point of time, you would need to raise very fast. And when you need to raise fast, you lose out on the negotiation. So if you raise too much, also you lose too much of your equity. So they always say raise the right amount, which is very difficult. It's but generally speaking, raise for around 1 year to 15, 16 months. Everyone will have different opinion on this. This is just my take on it. And from there, so you can just look for the next 16 months, how much you will be losing. So let's say you'll be losing around 600,000. So you can just raise extra, maybe 100,000. So 750. You raise 750, and you know at that point you'll probably be running short. And 3 to 6 months prior to finishing that money, you start raising one more round. All right? If you can just raise one round and never raise again, that's best. But that means you're not growing fast enough in tech startup world, because you need to raise at least 3 rounds to 4 rounds to reach exit. And yeah, so that's the general rule of thumb. You'll be raising seed round, Series A, Series B, Series C. But sometimes startups goes towards exit earlier than expected. So I would put this number, and then you'll see that. So I would put equity funding as let's say 750. And you'll see that I'll run at a loss starting from year 3 again. And then I have to raise again in year 3 and then go so on. So how much do I have to raise in year 3? Around, it says 260, but at that point I'll probably want to grow more and maybe raise more. So I'll only look at it again at that point of time. All right. So let's say if we do one round for all, so it's $1 million. $1 million. And now this sheet is more like a quick summary of your financials. The 3 things that you need to show to VCs on your pitch deck is your sales revenue, your net income, and your cash balance for the 3 years or 5 years. This is usually what is asked for as a basic requirement in any pitch deck. They wouldn't ask you for your financial model right away, because they'll just look at this, and then from there, as a VC, I'll just look at the last year's revenue and I'll say, okay, the revenue multiplier is 10 in this industry. If this company exits at 100 million, does it make sense for me to invest X amount right now? Based on discount rate, based on dilution and everything, which I'll explain in a bit. This is the annual statement that I talked about. So this will be this is your income statement for 5 years. So you'll see everything in thousands term. So your balance sheet, your cash flow, you can just simply copy this and put into a Word document or send them this Excel file right away. All right? And this last sheet is more your, let me zoom it out a bit. So this is your NPV / IRR. It automatically calculates, like I mentioned earlier, that your discount rate is again depending on where you are in your company. But as a startup, usually 50 to 60%. So if I put it as 50%, PE, this is based on industry comparables. So you can just find out what are your competitors or your comparables PE, and then just put it here. And it automatically calculates your NPV, which is your value, post-money valuation. Yes? Sorry? Do you do a balance sheet? Yeah, it does come up with your balance sheet. So from here, this is balance sheet. So your assets, your inventory, plant, everything, equity, total. But this is not total. Over here, it's not considered as your company's value. So this NPV or IRR is internal rate of return. This is sometimes VCs ask this, and you need to be able to know. It's based on your cash flow. All right. So your IRR in this term is 87%. If they've put in $1 million and your company's valuation is 3.1 post money, then you should offer them around 31 or 32%. 32%. Yeah. So this is kind of like a guide for you, but again, you can say that I'm looking to offer 25 and then negotiate from there. So it multiplies your last year, year 5 earnings and project your future and then discount it. So for NPV calculation, you need to take into account your future revenue as well, because the company doesn't die after 5 years. So you need to project. Sometimes the company takes a long time to get to profit, right? So you cannot just say your 5-year NPV is this much. You need to take your terminal value, which is taken from the PE. In the same industry, yeah. Again, you try to look for companies that are listed in the stock exchange, and then you can find out their PE. But I know it's difficult for startups, but what you can is try to find out from the easy way is, let's say some company just got acquired. What is their revenue at that point? What do you think is their gross margin? I mean your net margin. And then from there, you just multiply net margin and take the value divided by that and get your PE. Okay, it's not as easy to get these numbers, but try to get the closest numbers, and if not, ask someone who's in the industry and if they know of any numbers that you can use to make it reasonable. All right, now I'm going to look at it from a VC perspective and see whether when you come and present to me, whether your company makes sense or not in like 2 minutes. All right. So initially, just now we did from a startup perspective. As a company, how do we come up with the valuation? But once you present your valuation to a VC, I'm going to look at a quick and dirty way of how do you come up with. Okay, so from a VC perspective, usually VCs, before looking at this, VCs require cost of capital, of average cost of capital of 35%. That's the industry standard. So if you are going to invest into a VC, as an investor, they call them LPs, limited partners. So VC, venture capital, usually don't invest their own money to startups. They have people who are backing them. And it's considered a high-risk investment. So again, you know, high risk, high return, right? So early stage VCs, usually their expected return is around 35%. So this number is like industry norm. Again, some VCs says 30% if they're not performing so well. Some say 40 to 50%. All right. Probability of success of a startup is probably around 30% if it's very early. If you look at VCs in their portfolio, out of 10 companies, usually 2 or 3 survive. So I would just put in around 30%. If like you're on a later stage, you've raised 2 rounds already, your probability of success is probably much higher. But I'm talking about early stage startup would be around 30%. Okay, so that's the 2 things that are pretty much standard in all cases, but again might differ. What's the company's required funding? So just now we said the company requires $1 million, right? So let's say if I was a startup presenting to this VC, the VC will put in $1 million. Post-money valuation was around $3.1 million, all right? The equity offered, hence, is around 32%. The exit plan was to exit within 5 years, means to sell your companies within 5 years. Now, this retention rate, what it means is basically a lot of VCs, like I mentioned earlier, that you have to raise a few rounds, right? You don't just raise 1 round and you exit. Like, for example, Uber raised probably like 6 or 7 rounds till now, and they still haven't exited their company. Many companies usually raise seed round, Series A, Series B, Series C, and then go to exit. And you've heard from a few other startups that have come in and shared their experience here before, that they've raised like 2, 3 rounds. Even in Thailand, there's like 2C2P, UPB, Wong Nai. There are many companies that have raised, starting to get to Series B, Series C. And Okay, so how it works is basically the founding team, before you raise any external funding, you own 100% of the company, right? As soon as one VC comes in, let's say that VC takes 20%, means the founding team goes down to 80%, right? And then the next VC comes in, say, let me just draw up. So let's say there's a big pie here. The first one is, this is the founders, right? So the founders get 100%. Then the second round is 20% goes to VC1, 20%, and 80%. This is pre-funding. This is seed, 80%. Now, Series A. So there will be two VCs. The first VC1 will go down to 16% if VC2 comes in at 20%. I'm just giving you an example of a simple case. VC2 comes in and say, hey, I want 20% of the company. Now, where am I going to get that 20%? It's going to get diluted from everyone. So it's going to get diluted from the founder, and it's going to get diluted from VC1. So VC1 loses 20% of his 20%. So he's down from 20 to 16. If you take 20 multiplied by 80%, that's 16%, right? So that's, so second, after one round, they've already lost 4%. After Series B, they're going to lose more. And Series C, they're going to lose more. So by the time the company actually exits, first round investors usually lose, I've just put in a formula here. So they actually retain around 51%. And startup retain around 41%. As in the founding team, right? This is assuming every round is 20%, which is average size of each round.
Doesn't that also depend on how they negotiate the structure of the equity that they take?
So hardly any case is non-dilutable shares. No investors will come in when you have a non-dilutable shares agreement.
What if the investor negotiates for non-dilutable shares?
If a startup gives, then it's harder to raise the next round. So in rare case, very rare case, you get non-dilutable. And if you get non-dilutable, it's obviously of a small portion. If you give someone like that is a big advisor to you, non-dilutable 1% share or 2%, that might be a case, but not to general VCs. Anyone has any questions with the dilution? That's why that. So when a company exits, let's say a company gets sold for $100 million, the VC doesn't have 20% anymore. The guy who invested $1 million here would have only 10%. So 10% of $1 million means he'll get $10 million cash back from his $1 million investment. Now the question is that enough? Given the risk and everything that he is involved and that he's put in. So we have to run through this model to find out whether is that enough for him, right? So this model will give you that a VC requires, let's say in year 5, the earning is $10 million, and the exit multiple is 10 times, which is the PE. It'll come to exit valuation of 100 million. And then if taken into account the cost of capital and the probability of success, the formula says invest. All right? But if I change this to $9 million, it'll say do not invest. So it's very simple. It's all around numbers. And why? Why does it work that way? It's just because you need to achieve, VCs have minimum requirement to achieve for their investors as well. It's not they're doing it because they're happy doing it. They need to achieve a certain number. And given the risk that they're going to take with you, is it worth their return? So before you go and pitch to a VC, you better understand this too, and say, why are they keep on rejecting me? Does the number make sense that I'm proposing? Either you reduce your valuation or you reduce the amount. Usually the amount that you require is non-negotiable in a discussion. So the only thing that is negotiable is the percentage that you offer. Because if the amount that you require is negotiable, then it means you don't really need that money. VCs will ask you what's the minimum required money that you need, not the maximum. Right? Because they only want you to put in what's needed, and they'll use their own money to manage the rest. So this is simply the whole, this is basically, it's not as simple, but trying to cover every aspect of it.
Could you please explain what target multiple is? I think you didn't really.
Target multiple?
Yeah, that 14.95.
Okay, so this is like a number that comes about through formula. Okay. Okay, so every year if I need to make 35% every year for 5 years, that comes to 4.48. So meaning, if your probability of success is 100%, I'm sure that you will reach your exit value. You will need to reach 4.48 times in 5 years.
4.48 times
Your valuation.
the valuation.
So let's say you're proposing me today at 5 million valuation. You need to exit at least 22 million for me to be able to recoup my 35% per year.
And that's the product of the cost of capital and the probability of success?
No, that's just cost of capital and taking into account 5 years. So how it works is 1.35. So you just take 1.35 to the power of 5, and that will give you 4.48. Because every year it compounds, right? So if you save the money in the bank and it's 35% return, after 5 years you'll get 4.48 times the money that you put in.
Then how does the probability of success fit in there?
So probability of success, once I reduce that to 30%, means that, let's say I invest in 10 companies, only 3 of them will succeed. So then I have to recoup for the rest 7. So what I do is I divide this by 0.30, so it's equals to 14.95. So at least 15 times, let's say your value was 10 million you're asking for. You have to exit at $150 million for me to be able to make my money back in 5 years. If it's 7 years, it's even more. This is as a VC, I'll just put in these numbers that you give me how much funding you need, and what's your valuation, what's your year 5 earning, what's your exit multiple, and what's my retention rate, given which round you're at, and that's it. I'll see whether I should invest or not. Yes? This is a very subjective thing that each VC look at it based on their experience. Yeah. I mean, depends. Like, team is one factor, but if you already have like the biggest customer on hand, then obviously it's just risk. The more you mitigate the risk, the higher the probability of success. Yes?
Still thinking about these pies over here, the dilution diagrams.
Yeah.
Seems like the scenario you've mapped out, let's say you go through seed, Series A, Series B, and Series C. The Series C investor is going to come up and then exit. The Series C investor is going to come up with, ending up with 20%, a much higher
Yeah.
percentage
Yeah.
than the seed investor will. The Series C investor is investing in a period of lower risk and for a shorter time,
Yes.
right?
Yeah. At a higher valuation. Like Uber, they're investing at $5 billion $50 billion valuation. They cannot exit 10 times of that. So they can exit maybe 1.5, 2 times of that, but in a very short period of time.
They accept that.
Yeah. Obviously, it's almost a Series C investor is like a PE investment. A PE slash even almost close to a publicly traded company investment. So your expected return is not 35% anymore because you're a low-risk investment.
So you've been basically talking about the seed.
Yeah. I'm talking more about seed close to Series A. But obviously, you can still use this. You can see if you're a Series C investor, your dilution is, your retention is 100%, and you can just reduce your cost of capital to, say, 20%. This one to 100%, and you can still come up with probability of success will probably be 95%. Yeah. So you can adjust. This is not just early stage VC. Yes, you had a question.
One of the things like you probably in the Series C take less equity then because the risk is less.
Take less equity.
You give away less equity. You assume that every series you give away 20% equity.
Yeah.
Yeah, normally it's like that in the later rounds they take less percent equity.
Yeah. I mean, yeah, it depends again. But sometimes it's not the case. If you need a lot of money, like Uber needs like each time, like obviously they're giving out like 3%, 5%, but their valuation is crazy. Series C investor, say 10 to 30%. Maybe one figure, very rarely, but yeah, one figure. Any other questions? So everyone understands this? What's the most difficult part in this Excel file? Huh? I think it's just sitting down, taking time out from your precious time. I think it's important for every founder to know your financial. Even though if you have a CFO, you need to understand what is the driver to your revenue, what's the driver to your cost, what's your average burn rate. These are numbers where every founder needs to know. So it's not just the CFO or the CEO or the person in charge. So you need to know how long you have the money left for all these kind of things, all right? And this can be a good guide to at least, if you're not going to do the whole thing, at least do the first sheet, the quick financial model. And know, it is a good thing to set your expectations as well. Like, if you're going to be looking at it strategically, is it enough money to be made in the next 3 years, or do I need to adjust my model, my business model? Do I have to start doing marketing? Do I have to invest more or add another vertical in there because this vertical is getting saturated? These are the questions that come to mind when you look at the numbers. Okay? Yes?
Maybe a tip from your side, how do you come up with the burn rate if your expenses are fluctuating a lot? Like you have company setup costs, then you run a little bit, you lose your team, you acquire new teams, you change office space, there's like a cost of refurbishing the whole place, so you have kind of
No, so usually they don't ask you. Usually they don't ask, as a VC or as an outsider, you don't ask someone for their exact burn rate, but you usually ask for your average, or how much are you going to spend in the next 12 months.
just change the average a lot, right?
No, but if you say that how much you're going to spend in the next 12 months and divide by 12. So because if you're going to look for external funding, you got to be able to know how much you're going to need, right? How much you're going to spend. Obviously, some of it is going to be covered by your revenue, but you're not going to be profitable yet, so you need external funding.
I'm curious about how are you doing compared with this projection?
In terms of projection, this is like done like very long time ago. So
From when it was done like a very long time ago with numbers that you were trying.
yeah, I mean, I come and I have another file that I use, and that's more accurate number, and I adjust based on a monthly basis, or not monthly, but every 2 months I come and look at it and adjust the numbers. Every time you start going to due diligence, you have to update the numbers and so on. But yeah, I mean, pretty much as projected, but obviously every month let's say you come up with a huge campaign that you change your direction and all that kind of thing. So your cost structure, your revenue structure might change a bit. You got to update. Nobody is going to be able to know that perfect prediction. But at least you know that what's your path. Is it the same path you want to go? Is it going okay? Are you able to achieve it? And is it big enough? Is it going to cover your costs? Let's say if you put up these numbers and you say, it's not going to cover my salary, let alone my employee's salary, then why do you even get into the business after all? Some people don't even know. They haven't even looked at this. But you think it will work and you think that it will be able to cover its own expense, but really it will take 3 years to cover. And will you be able to wait 3 years under your own investment if you don't get investors? So that's a question to be answered once you have these numbers. All right? Yes?
5 years is a very long time, especially in the tech world, but even just in the ordinary world. And a lot of things can happen that could affect your projections.
Yeah.
The first thing that occurred to me is currency fluctuations. If you're doing your original projections in baht and then changing it to dollars, but other issues related to the rise of competition, disruptive technology, a new competitor. When you are making your projections, do you take an optimistic or a pessimistic perspective, or do you try and find something in the middle?
Try to find something in the middle. It's a most likely scenario. You can have both optimistic and pessimistic as an option. So you can save a file and make it different versions and look at it whether how much it differs. And if a VC say, what if another competition comes in? And you can say, in a pessimistic scenario, the valuation would still be around this much. Because given I've reduced my revenue by 30%, there is a field here called, if you go on top, it says here sensitivity analysis. So if you see this one, so you can put in negative 15%, negative 20%, cost of goods sold increased by 20%, 30%, and this changed your whole model entirely just by changing one field. So this is more like when you talk about, and you can save into a different version. But all right, then I think I'll just end the thing here. There's some food, some snacks there. We can chat informally after this. If you have any questions, feel free. If you want this Excel file and you can't find it anywhere, just email entrepreneurship@sasin.edu and then we'll send you the file. All right? Thank you, everyone, and have a good evening.